Welcome to CMA USA Exam Coach, your ultimate destination for mastering the CMA USA syllabus with clear, concise, and engaging lessons. Today, we are looking into our next topic, solvency ratios. What is a solvency ratio? How does it differ from a liquidity ratio? Let's discuss. In the last episode, we discussed liquidity ratios, which measure a company's ability to meet its short-term obligations. Now we have solvency ratios, which assess a company's ability to meet its long-term obligations. Long-term obligations refer to the debts and financial commitments a company is responsible for over an extended period, typically more than 1 year. These obligations are crucial for assessing a company's financial health and stability. Long-term obligations refer to a company's financial commitments that extend beyond 1 year. These include bonds payable, where a company raises funds by issuing bonds and repays investors over time with interest. Another key obligation is long-term bank loans, which companies use for expansion, asset purchases, or refinancing. Additionally, companies may have long-term lease agreements for office spaces or equipment, pension liabilities for employee retirement benefits, and deferred tax liabilities due to timing differences in tax reporting. Solvency ratios help assess whether a company has the financial strength to meet these long-term obligations without financial distress. All right, let's take a deeper look into solvency ratios. These ratios help us understand how well a company can meet its long-term financial obligations. So, what are the key solvency ratios we'll be discussing? 1. Debt-to-equity ratio. This ratio shows the proportion of debt and equity a company uses to finance its operations. It helps in understanding financial risk. 2. Long-term debt-to-equity ratio. A more focused version of the debt-to-equity ratio, this one considers only long-term debt, giving a clearer picture of long-term financial stability. 3. Total debt-to-total assets ratio. This ratio measures the percentage of a company's assets that are financed by debt, helping us see how much of the company is owned by creditors versus shareholders. 4. Interest coverage ratio. This ratio evaluates a company's ability to pay interest on its outstanding debt, which is crucial for determining financial health. These are the major solvency ratios we'll be covering in this topic. We'll break each one down, go through explanations, and provide practical examples to make them easy to understand. Our final topic will be leverage and financial leverage ratio. This is an important topic to discuss. The financial leverage ratio is a measure that shows the extent to which a company uses debt to finance its operations and growth. In other words, it helps assess how much financial risk the company is taking on by relying on debt instead of equity. A higher leverage ratio typically indicates higher financial risk, but it can also mean the company is using debt to potentially boost returns. Now, let's discuss the debt-to-equity ratio. This ratio measures the financial leverage of a company by comparing its total debt to shareholders' equity. It shows how much debt a company is using to finance its assets relative to the equity contributed by its shareholders. The debt-to-equity ratio is crucial because it helps assess financial risk. A higher ratio means the company relies more on debt, which increases financial risk as higher debt levels lead to higher interest obligations. On the other hand, a lower ratio indicates lower financial risk since the company is primarily funded by equity, making it less vulnerable to debt-related pressures. Formula for debt-to-equity ratio. Debt-to-equity ratio is equal to total liabilities divided by total equity. This ratio is widely used by investors, creditors, and analysts to evaluate a company's financial stability and risk level. As the name suggests, debt-to-equity ratio, the formula is simple. It's just total debt divided by shareholders' equity. No need to memorize the equation separately because it's already in the name itself. Debt comes first, followed by equity. So the calculation is straightforward, total debt divided by total equity. This ratio helps us see how much debt a company has for every DOL of equity. Let's discuss a simple example to understand the debt-to-equity ratio in action. ABC Corporation has a total debt of $500,000 and total equity of $250,000. Calculate the debt-to-equity ratio and interpret the result. Now, applying the formula, debt-to-equity ratio is equal to total debt divided by total equity. Placing the given values. Debt-to-equity ratio, == 500,000 divided by 250,000 equal to 2. This means ABC Corporation has a debt-to-equity ratio of 2, which indicates that for every $1 of equity, the company has $2 of debt. This suggests that ABC Corporation is highly leveraged, meaning it relies more on debt financing than equity. A higher debt-to-equity ratio like this can indicate higher financial risk, as the company has significant debt obligations. However, it can also mean the company is using debt strategically to fuel growth. Investors and creditors often compare this ratio with industry benchmarks to determine if the leverage level is reasonable or excessive. Here's an important tip to keep in mind. In the CMA exam, direct questions like this, where you're simply asked to calculate the debt-to-equity ratio, are rare. Instead, they often ask indirect questions. For example, they might give you the ratio and the total debt, then ask you to calculate total equity. Or they could provide partial information and require you to figure out missing values. This approach doesn't just apply to debt-to-equity ratio questions, but to many other financial calculations as well. So, always be prepared to work backwards, rearrange formulas, and apply logical problem-solving techniques. Understanding the concept is more important than just memorizing formulas. Once you truly grasp the logic behind the ratio, you can easily apply it to solve related questions, no matter how they are framed. Now, let's discuss the long-term debt-to-equity ratio. This ratio specifically measures the proportion of long-term debt a company has compared to its shareholders' equity. It helps assess how dependent a company is on long-term financing. A higher ratio means the company is relying more on long-term debt, which can increase financial risk due to interest obligations over time. While debt can be useful for expansion, excessive long-term debt may put pressure on the company's cash flow. On the other hand, a lower ratio indicates that the company is less dependent on long-term debt and is using more of its own equity for funding. This is generally seen as a sign of financial stability, though it may also mean the company is missing out on growth opportunities through leveraged financing. As the name suggests long-term debt to equity, the formula is long-term debt divided by total equity. Remember, long-term debt is equal to total liability minus current asset. Let's discuss a simple example to understand the long-term debt-to-equity ratio. ABC Corporation has a total long-term debt of $500,000 and total equity of $1 million. Calculate the long-term debt-to-equity ratio and interpret the result. Now, applying the formula, long-term debt-to-equity ratio equals to long-term debt divided by shareholders' equity. Placing the given values. Long-term debt-to-equity ratio equals 500,000 divided by 1 million gives 0.5 or 50%. This means that for every $1 of equity, the company has $0.5 of long-term debt. Since the debt is lower than equity, this indicates moderate financial risk, as the company relies more on equity than debt for financing. A lower ratio like this suggests that the company has a stronger equity position and is less burdened by long-term debt obligations. This is generally seen as a sign of financial stability, as it means the company has lower interest obligations and is less exposed to risks from debt repayment. However, it may also indicate that the company is being conservative with leverage and might not be fully utilizing debt to expand its operations. Investors and creditors often compare this ratio to industry standards to determine if the company's debt levels are appropriate. Now, let's talk about the total debt to total assets ratio. This ratio measures the percentage of a company's assets that are financed by debt. It helps us understand how much of the company's resources are funded by liabilities rather than equity. A higher ratio means that a larger portion of the company's assets is financed through debt rather than equity. This indicates higher financial risk, as the company has more obligations to repay. A very high ratio could suggest potential liquidity issues if the company struggles to meet its debt obligations. On the other hand, a lower ratio shows that the company is using more equity to finance its assets, which generally means lower financial risk. Companies with lower debt dependency are often seen as more financially stable. The formula is total debt to total assets ratio equals to total debt divided by total assets. Why is this ratio important? It helps investors and creditors assess the financial health of a company. Lenders use this ratio to determine the company's borrowing capacity and creditworthiness. It is useful in comparing companies within the same industry to see how much they rely on debt financing. This ratio is crucial in financial analysis because it gives a clear picture of a company's capital structure and risk exposure. Understanding this helps in making informed business and investment decisions. Let's discuss a simple example to understand the total debt to total assets ratio. The question is, ABC Corporation has a total debt of $300,000 and total assets of $1 million. Calculate the total debt to total assets ratio and interpret the result. Now, applying the formula, total debt to total assets ratio equals to total debt divided by total assets. Placing the given values, total debt to total assets ratio equals 300,000 divided by 1 million equals 30%. This means that 30% of the company's assets are financed by debt, while the remaining 70% is funded through equity or other means. A lower ratio like this suggests that the company has a relatively strong financial position, as it does not rely heavily on debt to fund its operations. Why is this important? A higher ratio would indicate that the company is more dependent on borrowed funds, which could lead to higher financial risk. A lower ratio means the company has more financial flexibility and may find it easier to obtain additional financing if needed. Investors and creditors use this ratio to evaluate how much risk the company carries in terms of debt obligations. Understanding this ratio helps in assessing the company's overall financial stability and whether it has a sustainable capital structure. Now, let's talk about the interest coverage ratio. This ratio measures a company's ability to meet its interest payments using its earnings. In simple terms, it tells us how many times a company's operating income can cover its interest expenses. A higher ratio indicates that the company has strong earnings and can easily cover its interest obligations. This suggests lower financial risk and a healthier financial position. On the other hand, a lower ratio means the company has less income available to cover interest payments, which could be a warning sign of financial difficulty. If the ratio is too low, it may indicate potential liquidity issues and a higher risk of default. The formula is interest coverage ratio is equal to earning before interest and tax divided by interest expense. Why is this ratio important? It helps creditors and investors assess whether a company generates enough earnings to pay its debt interest. Lenders use this ratio to determine a company's creditworthiness before approving loans. It is a key indicator of financial stability, especially for companies that rely on debt financing. The exact concept behind this ratio is that it tells us how many times the company's earnings can cover its interest expense. For example, if the ratio is 5, it means the company earns 5 times the amount needed to pay interest, showing a strong ability to manage its debt obligations. Now, let's calculate the interest coverage ratio using the given income statement. As we know, this ratio tells us how many times the company's earnings can cover its interest expense. Here we have earnings before interest and taxes EBIT, $1,610,000. Interest expense, $550,000. Now, applying the formula, interest coverage ratio equal to earning before interest and tax divided by interest expense. That gives us 2.93 times. This means that the company earns 2.93 times its interest expense, indicating a moderate ability to cover its interest payments. Understanding the standard ratio. The general benchmark for a healthy interest coverage ratio is 3. A company should ideally earn at least 3 times its interest expense to ensure financial stability and avoid liquidity risks. A ratio below 3 suggests that the company might struggle with debt obligations, while a ratio well above 3 indicates strong financial health. This ratio is crucial for assessing a company's financial stability, especially for lenders and investors evaluating credit risk. Now, we are looking at another important topic under solvency ratios, financial leverage ratio. What is financial leverage ratio? What is its importance? Let's check it out. Let's start with leverage. What is leverage? In a corporate setting, leverage refers to the use of borrowed funds to finance business operations or investments. Companies use leverage to expand, acquire assets, or enhance returns on investment. Understanding leverage ratios. A lower leverage ratio suggests that the company is primarily funded by equity, meaning it has lower financial risk but might also have limited growth opportunities. A higher leverage ratio indicates greater reliance on debt, which can amplify returns but also increase financial risk, as the company must meet its debt obligations. Leverage is a powerful tool, but balancing debt and equity is crucial for financial stability. Now, let's move on to understanding how we measure financial leverage. Before that, let's discuss degree of leverage. What is degree of leverage? The degree of leverage measures how sensitive a company's earnings or net income is to changes in its sales or operating income. It helps assess the financial risk associated with a company's cost structure and financing decisions. There are 3 types of degree of financial leverage. 1. Degree of operating leverage. 2. Degree of financial leverage. 3. Degree of combined leverage. A higher degree of leverage indicates greater earnings volatility, meaning small changes in sales or EBIT can lead to larger fluctuations in profits. Now, let's dive into the degree of operating leverage DOL. DOL tells us how sensitive a company's operating income, EBIT, is to changes in sales. It helps us understand how well a company can cover its fixed costs and how efficiently it turns sales into profits. How does it work? Since a business has fixed costs before making a profit, it first needs to cover these fixed expenses. The higher the DOL, the more sales impact EBIT, meaning a small sales increase can lead to a much larger increase in operating income. A company with high fixed costs will have a higher DOL, which means more risk but also greater potential rewards. Formula for degree of operating leverage. Degree of financial leverage equal to contribution margin divided by EBIT. Since contribution margin is sales minus variable costs, this formula shows how much revenue is available to cover fixed costs before generating profit. Alternatively, another way to calculate DOL is percentage change in EBIT divided by percentage change in sales. This tells us how much EBIT changes for a given percentage change in sales. Notes: DOL measures how well a company leverages its fixed costs to increase profits. A company with a high DOL benefits more from sales growth, but also faces higher risk if sales decline. Now, let's talk about the degree of financial leverage, DFL. DFL measures how sensitive a company's net income, EBT, is to changes in operating income, EBIT. In simple terms, it tells us how much a company relies on debt financing and how well it can cover its interest expenses. How does it work? When a company has debt, it must pay interest expenses, which come before reaching net income. A higher DFL means that EBIT has a greater impact on net income, meaning more financial risk, but also higher potential returns. If EBIT increases, net income grows at a higher rate, but if EBIT falls, net income drops even faster. This is the risk of financial leverage. Formula for degree of financial leverage. DFL equal to EBIT divided by EBT. Since EBT, earnings before tax equals to EBIT, minus interest expense, this formula shows how much of the company's earnings are available after covering interest payments. Alternatively, another way to calculate DFL is percentage change in net income divided by percentage change in EBIT. This tells us how net income responds to changes in operating income. Notes: DFL tells us how well a company covers its interest expenses and how debt impacts profitability. A higher DFL means higher risk, but also greater profit potential if EBIT increases. Now, let's look at the degree of combined leverage, DCL, which is a mix of both degree of operating leverage and degree of financial leverage. DCL tells us how sensitive net income, EBT, is to changes in sales by considering both fixed operating costs and interest expenses. In other words, it shows how the contribution margin covers both fixed costs and interest before reaching net income. How does it work? A company with high fixed costs, that is operating leverage, and high interest payments, that is financial leverage, will have a high combined leverage, meaning small changes in sales can cause large fluctuations in net income. If sales increase, profits grow significantly, but if sales decrease, net income drops sharply. This is the risk of combined leverage. Formula for degree of combined leverage equals to contribution margin divided by EBT. This shows how much sales revenue is available to cover both fixed costs and interest expenses before reaching net income. Alternatively, another way to express DCL is percentage change in net income divided by percentage change in sales. This tells us by how much net income will change for a given percentage change in sales. Notes: DCL measures the total risk and return impact of both operating and financial leverage. A higher DCL means greater earnings potential but also higher financial risk. Now, let's apply what we've learned and calculate the 3 degrees of leverage using a simple example. We have the shown financial data. Calculate the degree of operating leverage DOL. DOL measures how well the contribution margin covers fixed costs and how sensitive EBIT is to sales changes. Formula is contribution margin divided by EBIT. Here, 300,000 divided by 200,000, which gives 1.5. A DOL of 1.5 means that for every 1% change in sales, EBIT will change by 1.5%. This shows the impact of operating leverage due to the presence of fixed costs. Calculate the degree of financial leverage DFL. DFL measures how sensitive net income is to changes in EBIT, showing how well a company covers its interest expenses. Formula is EBIT divided by EBT. Here, 200,000 divided by 180,000, which gives 1.11. DFL of 1.11 means that for every 1% change in EBIT, net income will change by 1.11%. This indicates a low financial risk, as the company's interest expenses are relatively small. Calculate the degree of combined leverage DCL. DCL measures how sensitive net income is to changes in sales, combining both operating and financial leverage effects. Formula is contribution margin divided by EBT, here 300,000 divided by 180,000, which gives 1.67. A DCL of 1.67 means that for every 1% change in sales, net income will change by 1.67%. This shows the total impact of both fixed costs and interest expenses on earnings. Concluding, the company has a moderate level of operating leverage, meaning fixed costs play a role but are not excessively high. The financial leverage is low, meaning the company does not rely heavily on debt financing. The combined leverage shows a moderate total impact, meaning sales changes will influence net income, but the risk remains controlled. Understanding these leverage ratios helps businesses and investors assess financial risk and profit potential. Now, let's move forward. Now, let's discuss about financial leverage ratio. What is the financial leverage ratio? The financial leverage ratio measures the level of debt incurred by a business entity relative to its equity. It helps us understand how much of the company's assets are financed through equity versus debt. Formula is financial leverage ratio equal to average total assets divided by average total equity. Understanding the ratio. Higher financial leverage ratio means the company is using more debt financing. While this can boost returns when profits are high, it also increases financial risk. Lower financial leverage ratio suggests the company relies more on equity financing, meaning lower risk, but also potentially lower returns. Why is this ratio important? For businesses, helps in evaluating financial risk and making strategic decisions about debt financing. For investors, assists in assessing a company's financial health and risk level before investing. For lenders and creditors, helps determine the company's ability to repay loans and manage financial stability. Understanding the financial leverage ratio is crucial for assessing a company's financial structure and risk exposure. Understanding the financial leverage ratio equation. Let's break down the equation and its meaning. The financial leverage ratio is calculated as financial leverage ratio equals to total assets divided by total equity. Unlike other solvency ratios, this formula does not explicitly mention debt, but it still gives us valuable insights into how a company is financed. Example, calculation. Here we have total assets, $300,000. Total equity, $100,000. Applying the formula, 300,000 divided by 100,000 equals to 3. This gives us a financial leverage ratio of 3 or 3 to 1. Interpreting the result. What does a ratio of 3 to 1 mean? For every $3 of total assets, the company has $1 in equity. Since total assets equals to equity plus debt, the remaining $2 comes from debt financing. This means 2/3 of the company's assets are funded by debt. Why is this important? A higher ratio indicates greater reliance on debt, which increases financial risk, but can also boost returns if managed well. A lower ratio suggests the company is more equity funded, meaning lower financial risk but potentially slower growth. Understanding this ratio helps businesses and investors analyze the balance between debt and equity financing and make informed financial decisions. As we are winding up, let's quickly summarize the key ratios we covered in this topic. Debt to equity ratio, long-term debt to equity ratio, total debt to total asset ratio, interest coverage ratio. Then we discussed about leverages such as degree of operating leverage, degree of financial leverage, degree of combined leverage, and finally, financial leverage ratio. In our next episode, we'll dive into activity ratios, which measure how efficiently a company uses its assets to generate revenue. These ratios help assess operational performance by analyzing how well a business manages its resources. Make sure to practice questions and strengthen your conceptual clarity. Remember, don't just study to pass CMA, learn to apply these concepts in real-life financial decision-making. Knowledge is most valuable when you can use it beyond exams. Stay tuned and don't forget to like, share, and subscribe for more CMA study insights. See you in the next episode.